be advised that this recorded webinar has been edited from its original format, which may have included a product demo. To set up a live demo or to request more information, please complete the form to the right. Or if you are currently not on CSE Global, there is a link to the website in the description of this video. Thank you.
Hello everyone, and welcome to today's webinar, Optimizing the Fund Service Ecosystem, What Fund Managers Should Know. My name is Caitlin Aliberta from CSE's webinar team. And now I have the pleasure of introducing Karen Walsh, the National Director of the Financial Executives Alliance. Karen?
Thank you, Caitlin. Good morning and welcome everybody. We'd like to thank CSC for presenting to the group today and offering CPE credit for live participants. If you are not yet a member of the FEA, please take a moment to register at feaai.com. Membership is complimentary and is intended for senior financial executives of alternative investment firms and their finance teams. As a reminder, the views expressed in this webinar are the views of the presenters and do not necessarily reflect the view of First Republic Bank, its subsidiaries, or the FEA. I'd like to now introduce one of our outstanding FEA New York board members and our moderator for today, Anna Kelleher, CFO of One Rock Capital Partners. Anna?
Good afternoon. Thanks, Karen. I should say good morning. Really nice to be here with you all today. My name is Anna Kelleher. I'm One Rock Capital CFO. I've been at One Rock for the last 5 years. And it's a pleasure to be with you today. I'm also really happy to introduce to you Delphine Jones. Delphine drives business development efforts for the Private Capital Funds Group at CSC. Delphine has 25 years of experience in the fund world. I'm also happy to introduce to you Marshall Saffer. Marshall is a strategic business leader, also with 25 years experience, partnering with some of the largest private equity firms and hedge funds. So with that, we're going to move over to our agenda. And I think, you know, Delphine, Marshall, and I have been talking a lot. I think we can all agree that we've definitely been experiencing unusual times. I will say, personally, I've never spent so much time comparing notes with my peers on what's working and what's not in this ever-changing, demanding environment. We do hope that this webinar will help you navigate some of these challenges. I know for me, it's been very helpful just chatting with Delphine and Marshall over the last few weeks. So what we're going to talk about today is the fact that alternatives have moved into the mainstream. As a result, the opportunities and challenges facing the industry are multiplying. When it comes to fund administration, the expectation, as we all know, is that service providers will react to regulatory and cultural changes transforming the industry. I know oftentimes these days, my fund administrator is my first phone call. So there is a need to lead from the front, supporting rapid growth across all fund types and jurisdictional boundaries, while anticipating the needs of regulators and investors whose demand for operational reporting transparency continues to grow. In this webinar, we'll explore the evolving fund landscape, its importance to the alternative investment firms, and examine the expectations of the fund service providers ecosystem needed to support fund managers. Would you like to take it over?
Yeah, I think so. What I wanted to do for the group was kind of recap some of the things that I've been seeing in the industry. I have the luxury to meet with a lot of managers. So for the past few weeks, I was at the HFM with Intelligence $1 billion hedge fund event out in Montauk, so I spent some time there. I was at Game Ops and Cayman, which was a great show. If you ever get a chance to go down there, it was a fantastic show for operations people, both on the hedge and the private equity side. And then I was recently last week at the Markets Group PE event in New York. And what's interesting is regardless of whether you're a hedge fund, a private equity manager, or real estate manager, the themes and the topics that people were discussing were pretty consistent, right? Which were, as I've highlighted here, the rapidly changing business paradigm, which is who's investing in what returns are getting generated where, what segment of the industry do you have to participate in to meet your returns that you're looking to bring back to your investors. Regulatory changes impacting the operating models. There were several SEC rules that just came out, one which was a modification of Form PF, which is kind of vague when it comes to, I guess there's a trigger event, which is categorized by some major event that happens that you have to report on without being actually defined, which is kind of difficult to get around so far. And then the other one is doing due diligence and having a process of due diligence around your outsourced vendors. You've got fee structures and expenses, which are always impacting the alternative space. And then the market environment, which seems to be a little bit crazy for everybody. We've got rising rates, we've got economic uncertainty, you've got the debt ceiling problem, and then we've got geopolitical tensions. So I think all of this is kind of adding to the uncertainty of which way is up. And then you add that to staffing requirements and skill set requires for our industry, which seems to be in short supply when you get into the more complex derivatives and credit facilities and loans. There seems to be a lack of available resources stateside and internationally with people that are actually qualified and understand the asset class, how to account for it, how to trade it, and everything associated with that. And then I think the big elephant in the room is the liquidity and the financing costs and challenges. We've all seen the banking issues that have unfolded over the past several weeks. You've got rising interest rates, so your risk-free rate for returns is 4 or 5% based on a bank account. So that's putting definite pressure on the private equity and the hedge fund space in terms of how to generate returns that will exceed that than just leaving your money in as cash. Some interesting things that I've actually read over the past few weeks, which I wanted to share, is there was a Preqin study that actually said that 96% or 96 cents of every dollar going to hedge funds right now is actually going to the top 5 billion or people with over 5 billion in AUM. So fundraising is obviously a challenge for both PE and hedge right now, and launching funds and creating funds and managing funds. So I think it's an interesting time. That said, I think there are opportunities for people that can pick their spots and who can work with the right teams and providers and provide an operational model where people can focus on what's important to them and where their key strengths happen to be, and leveraging third parties for tasks or roles or responsibilities that might not be core to the investment process. I hope that kind of gives a little bit of oversight there and understanding about what I'm seeing.
And so Delphine, you've been in the industry for 25 years, so it'd be great to gain your perspective on this evolving landscape, if you don't mind sharing.
Not at all. And I guess I've been lucky to be able to have spent a lot of those years in different aspects of the industry. So I started off in the mutual fund world, which is highly regulated, and then segued into the private capital world. And I think what we're seeing in the private capital world is what you would expect, is based on the evolution, if you will, that the industry has been growing rapidly, let's say over the past 20 or so years. And what we're seeing is that with that rapid growth, there's a change. 20 years ago in private capital, fund managers were pretty much doing business with a handshake. They knew the investors that were coming into the fund. They were using Excel to handle most of the more complicated calculations. And maybe they had a general ledger system. Folks were using something like a QuickBooks. Time has changed and the need has changed as the industry has grown, and the fund administrator environment has grown with that. So all of a sudden, there are more fund administrators than ever before. And there was rapid growth in the industry. There was a great need for scale. There's a need for expertise, technology, and fund administrators had to step up to the plate a bit more because folks needed an alternative to doing all the work in-house. And they were looking for a partner to take on some of that burden for them. In 2018, assets under administration were about 10 trillion. We're looking now at a projection that we're going to go up to about 23 trillion by 2027. And so with that additional lift in assets and the work that's required, along with everything else that's happening in our industry, there's a need for more scaling up of the fund administrators. In 2018, we had a lot of things going on. There were a lot of mergers and acquisitions that was happening within the fund administration world. People decided to get additional capital in. So you saw a lot of equity players coming into the market, supporting those fund administrators, buying them. And then you started to see, a little bit of retraction as, that acquisition period kind of came to a peak. But there's still mergers and acquisitions going on out there. And I think that, we're still going to see a few more. We haven't seen the bigger companies doing mergers and acquisitions, as we did with some of the firms in the past. I came from a public accounting background of when I started in the business. Going to be dating myself a bit, but when I started in the business, it was the big 8, and then it went down to the big 4. We still have a lot of big players in the industry. It'll be interesting to see over the next 5 years if we see some consolidation happening at some of those larger firms. But a lot of the smaller firms, the boutique type shops, have disappeared as they've been absorbed by some of those larger companies. But there's growth in the market, which leads to a lot of competition. So we're hoping that within the players out there, that there still will be enough bandwidth and different options for you to look to as you're choosing your partner going forward. But again, I think it's part of the normal evolution within this industry, going from something small being handled in-house to expanding, growing, contracting, and then trying to get to a level playing field with a number of key providers out there. When you take a look at what's happening on the fund manager side, it's pretty much the same thing. I think it's, the fund managers are more sophisticated. They're dealing with more sophisticated investors. Everybody is demanding more. So fund managers are demanding more of their partners. The investors are demanding more of the fund managers. The regulators are in everybody's hair these days, trying to make sure that this industry is being conducted as it should be, that is being fair to everyone involved, and in many ways trying to look at it and parallel it with the industries that are much more regulated, like the mutual fund industry. So a lot of the rules and regs that the SEC are proposing, it's like, okay, wow, we're starting to look like the other side of the fence, the much more regulated side, if all of these things do go into play. So the regulators are really major in impacting this business a great deal. But today fund managers are also thinking bigger. When initially they may have come out with a single strategy play, now they're looking at different strategies. They're looking, as we saw in the survey, they're looking at launching larger funds. Every time they launch a fund, they want to grow it exponentially, and that's understandable. They're exploring new and multiple fund strategies. They're looking for a more diverse investor base. The SEC has helped with that to some degree when they changed the definition of the accredited investor. So they're allowing additional people the opportunity to invest on the private side. Things that the SEC are requiring with, let's say, the publishing of the quarterly financial statements in 45 days, all those type of things are really pushing the fund manager to be able to do things faster. The transparency has always been a demand. It's even much more so of a demand these days. And it's not only the institutional investors that are demanding transparency. I know groups like ILPA have been leading the way along those lines, but you do see a lot of other high net worth individuals who are looking for some transparency in the information that's being reported. So managers are looking and pretty much need a little bit more assistance in getting some of these things done. And we'll see how that goes. I think it's a fantastic partnership. But you also have to make sure that as a fund manager that you're getting what you need and that you're challenging the fund administrators to think outside of the box and that you're focused on where they want to be 5 years down the road. So I think if your fund managers are thinking along those lines, that would be helpful because their environment is going to change and consistently change as the industry goes.
And Delphine, that might be a good time to segue into the next topic that we have, if that works for you.
Sure.
Which I've seen a lot of changes in this life cycle. I'd be interested to hear your thoughts on that topic.
Okay, let's start off at the top. So fund formation. In the fund formation environment, and we were looking at setting up the fund, doing all the registration, getting everybody set in various jurisdictions. What we're seeing there is that there's an expansion in the jurisdictions that folks are getting involved with. 15 years ago, most of the funds were kind of US focused funds. That's no longer true. In order to grow the base, and while the US is still the primary market for private capital, we can't ignore the opportunities that exist abroad, especially in Europe. And so we've seen a lot more funds branch out into other jurisdictions. Cayman Islands has always been there, but people are also looking and setting up funds in Ireland, in Luxembourg, in Asia. So expanding the jurisdictions for a fund and setting up those structures is very important. Multi-entity structures are becoming much more of the norm now. It used to be that you had a fairly simple structure, right? You had a management company, a fund, and a GP, 3 entities. When I look at org charts now, I open them up and I have to close my eyes and open them up again because there's so many boxes and triangles on that page, and lines and dotted lines and swooping lines going back up to the top, that you need to kind of really digest what that fund structure is and what it's doing. So what we're seeing now is that funds are being set up with a fund, a parallel fund. They have co-investments hanging on the side. They are set up with blockers and splitters. They have aggregators at the top. They're using SPV vehicles to hold single portfolio investments. And so they may have 15 or 20 of those attached to a fund. So the entity structure has become much more complex. And each of those boxes, triangles, because they're entities have to be set up and formally, and there's documentation behind all of that. So the fund formation has just expanded greatly. Some of it is tax related, making sure you have the best tax strategy across your funds and the different vehicles that will help you accomplish that. And some of it is legal, making sure that you have the legal safeguards that you need up and down the various boxes to protect the fund, the advisors, to protect the investors. So a lot of that is happening. You have the offshore investors, that is another set of boxes within blockers. And then you have to get into, in those other jurisdictions, Luxembourg, Ireland, if there's different structures that need to be set up there because they may work a bit differently and they may have more efficient strategies and entity setups that work better in those jurisdictions. So fund formation has just kind of taken its own road and blossomed a great deal. When I look at fundraising is always going to be focused on delivering the right investor experience for a lot of folks. You need to be out and raising, and most managers tell me that they never stop fundraising, that they're always doing some type of soft selling because they know the next fund is right around the corner. I think what the industry has tried to do is make that experience better for the investors. What we're seeing now is that data rooms have become pretty much the norm, so that you can deliver the documents to the prospective investors in a very controlled environment by allowing them access into a room that has the basic information that you would want them to see. So data rooms are becoming a norm. We're also seeing that with fundraising, being able to vet your investors have become a bigger exercise than it has ever been. So making sure that you have the documentation that's required to comply with AML, KYC, FATCA, all of that now is starting with the fundraising process. And that has become almost an industry of its own to make sure that those requirements and getting down into the details and getting documentation from your investors, that all of that has become a big lift when it comes to fundraising. It used to be that you knew the guys that were coming into your fund, you socialized with them, you worked with them, et cetera. That's no longer the case. And if it is the case, you still have to make sure that the guy that lives around the corner from you, that you still have documentation to prove that you know that person well. So again, that has really expanded. We're also seeing that with fundraising, again, with technology, that people are looking more towards automation to help with the subscription process. So electronic subscriptions have started to take off. And rightly so, there's a lot of documentation to get through. if you set it up correctly, it can step your investors through each of the processes within the subdoc. If something doesn't apply to them, it'll skip them over those areas and get down to just those things that that investor needs to focus on. And in many of those subscription processes, you can also collect the data that you need for the AML KYC process. When it comes
and
to
Delphine, I can share that's something we recently implemented, and many of my peers are doing the same. So I've definitely, the last year or so in particular, I feel like it's really taken off.
Well, you know, it is helpful for your fund administrator as well, because now all of that information is collected electronically. I can't tell you how many times I tried to read somebody's address and you're like, okay, I still can't figure that thing out. So, you know, having that done in a much more neat and organized way just helps everyone downstream.
We're also seeing it as a standalone service. We're getting a lot of requests from our clients right now where they might not want us to be the fund administrator, but they're looking for an outsourced KYC provider. And then this concept of a passport, right? Once it's been done by a given provider, the data should be able to get shared to other parties, right? So you're not doing the same thing over and over again. So it is an interesting space. I agree with you.
Yeah. Okay. And when it comes to portfolio management, on the portfolio side, you know, we're seeing a couple of things. As you get more involved with transborder transactions, portfolio management is becoming much more tricky, and therefore fund managers are looking for someone to help them broker those type of transactions. So there are services out there that specifically focus on those elements, making sure that you avoid conflicts, making sure that the deal actually gets done in the best possible way, making sure there are no compliance if you're working across borders. So that's become a very big business. I'm also hearing from fund managers that they need much more of a portfolio management tool or tools. In the past, that has not necessarily been the case, especially on the private capital side. You know, people have been keeping things in Excel, right? But, you know, Excel is great for a lot of things. It's just not the answer to everything. And as you're trying to integrate systems and being able to put information in the front, in some type of front system, being able to analyze your positions, have that information flow a bit more seamlessly to other systems for calculations, doing performance analysis, being able to report the information onward to your administrators and to your accounting teams. Those type of systems have always existed on the open inside of the business, not so much on the closed inside, but I feel that managers are looking for much more along the lines of that front end process to help them get truly from doing things at the front end and have it sweep all the way back to the end of the process. End of the process, realizations and liquidations. What we're seeing is that, you know, funds don't have a 10-year life. No matter what people say in an LPA agreement, I've rarely seen a fund that actually stops and everything is wound down at 10 years. Have you guys been seeing those timeframes expand as well?
I definitely have.
Yeah. So what you have then is you have an LPA agreement that says 10. It allows a couple of years of automatic renewals, and then you have to get approval if you have to go beyond that. And so I think the average life that I've seen so far for most funds is about 14 years. So when you're down to the last one or two positions in the fund, you know, do you want to have to actively manage that? Or as a fund manager, do you really need to take those resources and focus on the next fund that you've raised? And so we're seeing the dilemma there. And services that are being offered in that category are, you know, creating a liquidation trust that you can move those assets into a liquidating trust. But I think more prevalent right now, and the talk at almost every single conference that we've gone to, is continuation funds. So folks are looking for a way, especially if they still, you know, wholeheartedly believe in those one or two assets that are there, and they just need a little bit more time to get to the right level of liquidating them. Continuation funds tend to be the answer. And then, you know, as you go into a continuation fund, it pretty much starts you back at the top of the cycle, right? You're going back to, you got to form a fund, you got to get some new capital in, you got to do the management of those positions. So it takes you back to the beginning of the life cycle. When it comes to fund administration tends to kind of wrap its tentacles around everything. So within fund formation, working with the administration, you're not just doing these days just the accounting for the fund, you're also helping out with almost every aspect of the life cycle. So you're helping out with fund formation, you're helping out with capital raise, et cetera. So we're seeing that fund administration has kind of expanded as well. So that idea of a back office being invisible to investors is also disappearing. Now the larger LPs, they want to know who your fund administrator is if you're using a fund administrator. And in some cases, we're hearing that LPs are almost insisting that the fund manager use a third-party administrator as opposed to keeping the work in-house. So that has had a prolific effect on fund managers, especially if they've had the work in-house, to have to think about outsourcing that work to someone else. Due diligence among the larger institutional limited partners is also ratcheting up. They want to make sure that, the middle back office, whether it's in-house or is, outsourced, that they know that the information is going to be pristine. They understand that the reporting is going to be accurate, complete, and that it's going to be delivered on a timely basis. So they're doing much more due diligence to make sure that the fund manager has a solid structure that would be able to deliver on all facets of the operation. We've seen that as well. We've had a number of our larger clients, their larger investors come in and kick our tires. And it's always interesting. It's like, yep, we got real buildings here with real people. You can come on in, kick our tires, and we'll even buy you a cup of coffee. So, that's becoming much more of the norm. When I get RFPs, most of the RFPs have a section that deals with due diligence questions that are coming from the LPs. So that's always interesting, and seeing what else they're interested in as they're investing in these funds.
And
so
that's great. I wonder. Oh no, go ahead, Marshall.
I just had a quick question, because I think another topic that I wanted to get your impression on is, and maybe Delphine, is secondaries, right? There's this all this talk about being able to the secondary market and what that's doing and the state of that. Do you get involved in the secondaries, or have you been hearing about that as well?
I have, and I've attended a number of sessions on it. It's not something we've taken advantage of late, but I would say a number of my peers have. Yeah, that's definitely the case. I think it slowed down a little, it feels like, but yeah, definitely over the last few years, it's been a hot area. Marshall, interested to hear, when you talk about the ecosystem, what exactly do you mean, if you don't mind clarifying?
Yeah, when I'm talking about the ecosystem, it's the parties, third parties, trading partners, other funds, banking, everybody associated with running a fund, right? So your ecosystem is your internal staff and people.
Right.
Your ecosystem is the lenders. It might be the prime brokers if you're a hedge fund, but it's all the people, vendors, technology partners, everybody that's associated with running your fund successfully is what I consider the ecosystem. And I think it's changed. And I think it's become highly specific based on strategy and types of funds, to where a generic type of infrastructure might have sufficed for years past, that all these strategies have become highly specialized. And I think that the ecosystem for each of those silos, or the specialization of each strategy or fund type, is demanding different partners that you might want to look at and evaluate to help you on your journey of running your fund. And so that's what I mean by the ecosystem. Everybody you're going to touch, everybody you're going to interact with, everybody that you need to support the initiative of running your fund. I think as I said, it does vary based on hedge, PE, VC, real estate, right? The systems that each of those systems require, right? Typically in the hedge fund space, you're looking at Infusion, you're looking at Advent Geneva, you're looking at Aligned Data. If you're looking at PE, your backbone or the administrator is usually using something like InvestTran. If you're real estate, you're probably going to be on Yardi. So the technology varies based on the asset class and the type of fund. When you talk about the strategy, right? Different investors, different people that might be giving you money, The interesting thing that I learned at one of the conferences was that if you're a hedge fund, and let's say you want to go into private debt or private credit, a lot of people make the mistake that if I have a relationship with a large institutional manager, I'm just going to be able to fundraise. I've had a successful hedge fund strategy. I'm now going to do private debt. I go back to the same people and they should be able to give me money. And it turns out that that's not necessarily the case, that each of these allocators have specialized groups that do the evaluation of strategies. And just because you've got a relationship with one allocator in one area does not mean that will translate to a new strategy you might want to launch, which I thought was kind of interesting. I think the legal structures are also highly complex and changing based on strategy. And in terms of the life cycle phase, they might be different, right? A hedge fund versus a private equity versus a VC type fund is going to have a different time frame, different people that are going to be associated with that, and requirements to make each one successful. Does that kind of make sense?
Yeah, no, definitely. Should we move on to the next slide, which is fund service ecosystem for multiple strategies?
Yeah, I thought this was kind of interesting. Actually, Delphine pulled this together, so I can't take credit for it. But
That's
it
okay.
essentially
We're
is just,
sharing.
it looks like it looks at individual tasks at a granular level between large firms and smaller firms in terms of functions that each have deemed to be core or things that they've considered outsourcing, right? And so it gives you a general landscape. I think the trend that we're seeing is that we're getting more and more calls every day for not just fund administration, but for daily support for all sorts of operations for various funds. So for a hedge fund, it might be, I want you to deal with everything on a real-time basis, on a post-trade basis, from trade booking to settlement to reconciliation to margin to security finance. If we're dealing with some of our private equity partners that we're working with right now, they seem to be wanting to launch debt funds and get into loan administration and loan agency. Even if they don't want to change fund administrators, we're still getting the call for these outsourcing services that they're looking to actually use to support the new strategies or the new business lines they're trying to get into. And the interesting thing about this is we're also seeing that by outsourcing or by leveraging a third party, you've got the ability to scale up and scale down rapidly without having to incur the costs of systems and personnel if you were to traditionally do it in-house. So that's kind of what this slide was supposed to surmise. Did you want to add anything, Delphine?
No, you did an excellent job. Exactly.
Okay.
Mm-hmm.
Yeah, no, I definitely find that it's helpful to rely on experts these days because issues are getting way more complex. So you really need specialists as opposed to trying. It's really hard to bring people in-house to manage all these issues.
And I think with settlement cycles that'll be changing, going from T3 to T0, it's definitely going to have an impact across the industry.
Reevaluating a criteria to optimize the ecosystem.
Oh, sure. So when you take a look at the ecosystem, is there ever a good time to be, when do people have time to sit down and kind of say, okay, let me just think about what I have? I don't think that time exists for anyone, but it's such a key thing to do, sitting down and thinking about where you are now, where you're headed, and do you really have the right players involved within your ecosystem? So, when you take a look at the support for complex fund types, looking at the complexity of funds, making sure that you have the right service partners who can deliver across a myriad of different investment strategies around the world, I think is important. But as Marshall said, what we're seeing is that it's hard to find one shop that fits all, and you may have to focus on, depending on that strategy, do you have the right service provider for that particular strategy? But operational scale is very much a consideration here, and making sure you have the best talent and making sure you're using your talent for its best uses. And if your internal people, if that's not the best use of their time, their talent, then consider moving that out to somebody else who is best in that category. Regulatory compliance is something we're all facing. It's not just with the SEC. When you look internationally, there's more compliance on the international side of things than there are here in the US. So that the CBI, which is the Central Bank of Ireland, the CSSF, which is the Commission de Surveillance des Secteurs in Luxembourg, all of those groups have very, very stringent requirements as relates to private capital fund, again, much more so than the US. Likewise, AML, KYC, FATCA. You have to really understand, what pressures are going to come when you're launching these new funds as far as the new regulations go, and finding a partner that can help you with all of those things. Investor expectations. Investors are expecting to get more, to get it faster. They want to make sure that their money that they're paying out for expenses are buying them the best service possible and being used to keep the alpha down, and especially in those early years. So looking at investor expectation and making sure you can get your arms around those, and when needed, looking for additional help to make sure that happens. The use of portals is, 10 years ago, everybody was sending things out via email. And now portals have become almost a mainstay in how we're getting information out to the LP. So that is still something that's important. I always think that portals are going to start evolving more and more as they try to use portals to help fund managers manage their investor base. When it comes to technology, technology is going to be key, right? You only have so many people, so many hours in a day. We're going to need technology to help us. We've seen what technology has done for us as we went into the COVID years, and how we're all sitting here doing these type of presentations on a day-to-day basis now. So technology is going to continue to be huge. Some of the key things that you're looking for in technology, you're looking for things that are cloud-based. You're looking for things that can handle multi-asset classes, multi-currency as far as accounting goes. You're looking for systems that have integrated general ledgers. You're looking for web interface, core cybersecurity, and those type of safety features are a must-have. Open architecture is also very important to make sure that the systems that you're working with can speak to other systems, can send APIs over to a different group of folks to continue streamlining the process of getting information from one place to another. We mentioned electronic subscription processes as being a big item now. CRM, making sure you have investor information and being able to use that information and access it readily is important. All of that comes with, wrapping it around audits and internal control reviews. So SOC reviews on the technology platforms, ISOs are also very important. But you want to look for integration. You're looking for straight through reporting, as seamless as possible when you're talking about technology. And last but not least, on the fund administration side, the back office is no longer invisible. The back office now plays a major role. LPs want to make sure that you have strong administration. They want to make sure you can deliver reports on time, accurate, complete. Consistency is the name of the game. I think consistency has struggled over the last couple of years. It shouldn't. We should all expect consistency as it comes to the reporting for this industry. So everybody needs to push their administrators, their in-house teams to make sure that is happening. That's our reputation within the industry. And I'll stop it at that.
I do think it would be helpful to, what are the key considerations, Marshall, that you think?
I think Delphine covered a lot, and we're running short on time. But I think we have to leave everybody with the thought that fund administration and service providers in various models, I don't think they're a commodity. So I think that it's going to be bespoke to each firm. I think that vendors that can provide bespoke solutions and scale are going to be the people that actually do well by you. And I think these are just some of the touch points, and I'm not going to go through them, that are important that people need to be thinking through.